Hey guys, what's up? Welcome back to another video. In this video, I'm going to be talking about a stock that's pretty popular, and they recently announced earnings for the first quarter of fiscal year 2023. And that stock is Starbucks. And we can see that over the last 5 years, they're up around 81%. And over the last year, they're actually up 26%. So they're completely outperforming the rest of the market that's down 8%. And so in this video, I'm just going to look into some of the recent news that's come out surrounding Starbucks. I'm going to look at their financial statements and then figure out if they are currently trading at a good buying opportunity by using a discounted cash flow model to figure out the intrinsic value per share for Starbucks. And so first and foremost right here, we can see in this article, they talk about how Schultz, the founder and CEO of Starbucks, recently stepped down from position of CEO, and a guy called Laxman Narasimhan is going to take the helm as CEO. So if I scroll down here, you can see they point out that Howard Schultz, founder and CEO, stepped down for the third time. This is his third time stepping down as CEO, but he'll continue to be a member of Starbucks board of directors. And they point out that the reason why they think that this new guy, I'm going to call him Laxman, the reason why I think Laxman is going to be a good CEO is because of his immersion into the business coupled with his experience as a proven brand builder. Apparently, we can see right here from this little paragraph here, they point out that he was previously the CEO of a British household goods maker called Lysol maker Reckitt Benckiser, and he was credited with boosting the sales of health and hygiene products, and on top of that, he used to be the global chief commercial officer at PepsiCo. And so they're basically counting on this guy to carry Starbucks into the next phase of their growth. So we'll see how he does. And then right here, we can see their financial statements. This is their income statement. They're comparing the quarter ended January 2022 to January 2023. And we can see that during that time period, year over year, their revenues have increased from around $8 billion to $8.7 billion. So they're up around 8% year over year. So that is definitely pretty impressive, especially considering the fact that over the last year, the rest of the market has declined, but Starbucks has managed to grow their business. On top of that, not only did their revenues increase, but their net income increased as well. We can see it increased from $815 million to $855 million. So up around 5% year over year here. So pretty good growth for Starbucks. Then right here in their balance sheet, we can see that right now their total assets come out to be about $28.2 billion, up from $27.9 billion in October of 2022. And we can see that they actually have more liabilities on their balance sheet than they do assets. So they do have a negative equity position of negative $8.6 billion. That being said, though, we can see, interestingly enough, their additional paid-in capital account here decreased from $205 million to $67 million. And so that could be indicative of the fact that they've been repurchasing shares, and that could be something that contributed to this increase in their share price here. And so lastly right here, we can see their cash flow statement comparing the quarter ended January 2022 to January 2023. And operating cash flow for the first quarter of 2023 was $1.5 billion, down from $1.8 billion year over year. And then we can see that they didn't return as much value this year as they did last year to shareholders, but it was still one of their primary financing activities. In terms of dividends paid, they paid out cash dividends of $608 million this year, which is up from $576 million in the year prior. But they repurchased way less common stock, as we can see right here. In 2022, they repurchased $3.5 billion, but in 2023, they only repurchased $191 million. So they still prioritized returning value back to shareholders, but not nearly as much as they did last year. And so now I'm going to look at this discounted cash flow model to figure out the intrinsic value per share for Starbucks. Yahoo Finance is estimating that the company is going to grow at around 18% for the next 5 years, compounded annually. So I cut that in half to 9% to be conservative for the next 5 years after that. They had around $4 billion of free cash flow in their most recent full year, about a $20 billion debt position on their balance sheet after netting that against their cash, and around 1.15 billion shares outstanding. That puts their estimated intrinsic value per share at $64 per share, which means that if we're comparing that to their current share price here, they're currently not trading below intrinsic value per share because they're trading at $104 per share. So they're trading at almost 2 times their estimated intrinsic value at the moment. Then on the right hand side here, I compared them to some of their competitors, McDonald's and Yum Brands. Yum Brands owns Taco Bell, KFC, and some other fast food chains. And we can see in comparison, McDonald's and Yum Brands have way better profit margins. McDonald's comes in first place at 56% and first place with net profit margin at 26%, whereas Starbucks is last placed with their 19% gross profit margin and 10% net profit margin. But that being said, we can see that across the board in terms of PE ratio, they're basically right next to each other. 28 times earnings for Yum Brands, 32 times earnings for McDonald's, and 34 times earnings for Starbucks. And then in terms of dividends per share, it looks like McDonald's pays out the best dividend per share. So if you were going to compare these companies against each other from a competitor analysis perspective, I would probably give it to McDonald's because they're paying the highest dividend and they also have the best profit margins here. Starbucks doesn't really seem to be dominating their competition here in terms of profit margins and dividend payout. And so lastly, to end off the video, I wanted to compare Starbucks to some of the other videos we've looked at in the past, other companies we've studied in past videos. And we can see first and foremost in this chart here, comparing their share price to intrinsic value. We have 4 companies we've looked at over the last few videos that are trading below intrinsic value per share: General Electric, Albertsons, ConocoPhillips, and Google. Those were the only 4 companies so far we found that are trading below intrinsic value. Aside from these companies, the companies that were trading closest to being below intrinsic value were these companies: Verizon, Accenture, Chevron, Adobe, Lockheed Martin, and now Starbucks coming in at 10th place, trading at around 1.62 times their estimated intrinsic value per share of $64 per share here, because they're trading at $104 per share. In terms of growth rate, we can see that Starbucks comes in 4th place. They have an estimated projected growth rate of 18.2% or 18.02%. So that puts them in 4th place behind Tesla's estimated 18.5% and ahead of Netflix's estimated 15%. And then we can see in terms of profitability ratios, Starbucks didn't have very good profitability ratios, came in at around 20% for gross profit and 10% for net profit. That's not good enough to put them ahead of the other companies we've looked at in past videos. We can see nobody's been able to knock Adobe off of the top of the gross profit margin list at 89%. And then if we scroll down here, the lowest was Amazon's at 43%. Right now, the chart just has Meta, Eli Lilly, Microsoft, Johnson & Johnson, McDonald's, Google, Nike, Verizon, and Amazon. So Adobe is still holding the number 1 spot. Starbucks wasn't able to make it onto the chart with their 20% gross profit margin. In terms of net profit margin, Microsoft is still holding the number 1 spot. Nobody's been able to knock them off the top. The chart right now is owned by Microsoft, Adobe, McDonald's, Apple, ConocoPhillips, Eli Lilly, Google, Meta, Johnson & Johnson, and 3M Company. Starbucks had a 10% net profit margin, so they weren't able to make it onto the table here. Lastly, we can see stock performance over the last 5 years. This chart right now is owned by Tesla, AMD, Eli Lilly, and Apple, and Microsoft. Those are the main 5 companies that have been doing really well over the last 5 years, especially Tesla and AMD. Eli Lilly, being a healthcare stock, surprisingly is actually doing better than Apple and Microsoft in terms of stock performance. We saw in the video we looked at for them that they're returning a lot of value back to shareholders. But lastly, it's Adobe, Google, Nike, Accenture, and ConocoPhillips. We saw that Starbucks over the last 5 years is up 81.77%. So that's not enough to get them ahead of ConocoPhillips' 81.88%. So all in all, comparing them to the other companies we've looked at in past videos, it looks like in terms of stock performance and profitability margins, they're not doing as good as other companies we've looked at. And then in terms of growth rate and share price compared to intrinsic value, they did well enough to make it onto the table and remain competitive against other companies we've looked at. Obviously, as I say in all these videos, these companies come from different industries, so the profit margins and stock performance are definitely going to be a lot different. But I like to do this analysis personally just because it gives me a good perspective, just seeing which companies I might want to consider more heavily investing in when ranking them against each other, even if they're not from the same industry. In terms of comparing them based on the industry that they're in, it looks like Starbucks is also not dominating their competition, McDonald's and Yum Brands, in terms of profit margins, and also in terms of dividend payout, that would probably go to McDonald's. And obviously, in terms of the discounted cash flow model, they're not trading below intrinsic value per share at the moment. So I'm not too sure what to make of Starbucks at the moment. Over the last year, their stock has been performing extremely well. but it looks like McDonald's is doing better in terms of profit margins. And if they're not trading below intrinsic value per share right now, it might be wise to wait a while to see if I could potentially buy into the stock once they are. But I'm not too sure. Let me know in the comment section down below what you guys think of Starbucks. Leave a like on this video, subscribe to the channel, and I'll see everyone in the next one.